Good morning. This is Larry McMillan with a stock market update on Monday, December 12th. So, as we come into what's supposedly a bullish seasonal period of the year, the market is struggling with the economic data that is about to be released or even has been released. But tomorrow is the CPI. The next day, the FOMC meeting concludes. And then on Thursday, there's an important economic number coming out of Europe. So near-term volatility is very high. For example, a SPY straddle for this week costs about $13, and that's probably about where it should be. So perhaps once we get through this short-term volatility here that's certainly to be produced by these economic numbers, the more steady bullish seasonality will kick in. Meanwhile, there's support on the S&P index at 3,900. We've violated the previous support at 3,940, but it's kind of held in here. However, I think if we break 3,900 and close below that, then there will be a heavy selling coming in, at least for a short term, because there's been so much trading here just slightly above the 3,900 level. The next support level would probably be somewhere closer to 3,700. The equity-only put-call ratios technically remain on buy signals. I say technically because that's what the computer analysis says. However, looking with the naked eye, they are not making new lows like they should be if they're really on strong buy signals. So that's a caveat. The standard ratio, in fact, hasn't made a new high for over 10 days. So by the original definitions that we put forth for these indicators, that is a sell signal. The weighted ratio is still clinging to its buy signal, but has not made a new ratio for the last few days either. The breadth of the market has been terrible, especially in 3 of the last 4 days, and so the breadth oscillators are on sell signals. They have not reached oversold conditions yet, and so that's just another short-term negative for the market. The number of new highs on the New York Stock Exchange continues to be a pretty low number, and so that indicator remains negative as well. So that brings us to the volatility index. Now, VIX has started to increase here as the market's fallen back in the last week plus, and it's in spiking mode. So while VIX is in spiking mode, that's a short-term negative for stocks, but eventually it will generate a VIX spike peak buy signal. As VIX is increasing, though, it's starting to approach its 200-day moving average. It's less than 2 points away from there now. And if we were to cross above there, that would terminate the current intermediate term trend of VIX buy signal. So those are a couple of potential negatives that we're looking at. But again, 2 points is a fairly large distance on VIX. As I mentioned, the construct of volatility derivatives is positive, but the short-term volatility index on the CBOE is quite high. That's because of these upcoming economic figures that are going to be released this week. So once that gets out of the way, that should leave a positive picture from this indicator. So summing it all up, 3,900 is an important level. If we close below there, that will probably override everything else, at least for a short term. We still do expect some bullish seasonality to come in here in the last part of the month and into the early part of next year. And meanwhile, we're trading signals around this in our daily indicators, so I invite you to visit our website and investigate what our daily indicators are saying and what they're all about. Meanwhile, have a great week trading.